The most dangerous moment in your financial life is not when markets crash, it is when you believe they never will. That is when complacency sets in. That is when investors build strategies that only work in calm weather. And then a headline appears, a world leader dies, markets tremble, commentators speak in urgent tones, prices swing wildly. Suddenly, the future feels uncertain in a way it did not just yesterday. Here is the unexpected truth. Markets are designed to absorb shock. They are built to process tragedy, political change, uncertainty, and fear. What destroys wealth is not the event itself, it is the human reaction to the event. When you understand that distinction, everything changes. Because if volatility is normal, then panic is optional. And if panic is optional, then discipline becomes your greatest advantage. In moments like this, it feels as though something fundamental has broken. The news cycle intensifies that feeling. Experts appear on television with complex charts and confident predictions. Some warn of cascading consequences. Others claim this is the beginning of a new era. The language grows dramatic. Words like unprecedented and historic are repeated until they lose meaning. And in the middle of that noise sits the ordinary investor, staring at a retirement account that suddenly looks fragile. The instinct to act is powerful. It feels responsible. It feels instigent. Doing nothing feels careless. Yet history suggests something profoundly counterintuitive. The most intelligent response in moments of market shock is often restraint. John Bogle built an entire philosophy around that idea. He did not deny that markets fall. He did not pretend that global events are irrelevant. Instead, he emphasized something far more important. The stock market is not a prediction machine reacting to one headline. It is a living reflection of thousands of businesses, millions of workers, and billions of daily transactions across the globe. When you own a broad index fund, you do not own a guess about tomorrow's news. You own a slice of the productive capacity of an entire economy. And productive capacity does not vanish because of a single event, no matter how dramatic that event may feel. When a leader dies and markets shake, prices adjust. Investors reprice risk. Traders reposition capital. But the underlying companies continue producing goods, delivering services, hiring employees, and serving customers. Restaurants open their doors. Software firms release updates. Manufacturers ship products. Insurance companies collect premiums. Pharmacies fill prescriptions. Life continues. Economic activity continues. Ownership continues. The market's short-term reaction is emotional. The market's long-term return is mathematical. This is where most people misunderstand risk. They see volatility and equate it with permanent loss. But volatility is movement. Permanent loss is something else entirely. Permanent loss happens when a business fails beyond recovery or when an investor locks in a decline by selling at the worst possible moment. If you sell during panic, you convert temporary price fluctuation into a permanent reduction of your capital. That is the quiet danger hidden inside emotional decisions. Consider what actually happens inside a broad market index during a shock. Some companies may suffer, others may benefit. Defense firms may rise while travel stocks fall. Energy companies may react differently than technology firms. The beauty of broad diversification is that it absorbs these crosscurrents. It does not rely on predicting which single sector will respond favorably. It simply owns them all at extremely low cost and allows the market mechanism to rebalance itself over time. Low cost matters more than most investors realize. If your investment expenses are reduced by even 1% per year, the long-term impact over decades compounds dramatically. A difference that seems small in a single year becomes enormous over 30 or 40 years. Costs are certain. Market returns are uncertain. Bogle understood that eliminating unnecessary costs was one of the few levers investors could control with precision. Moments of crisis tempt people to abandon that discipline. They move into high-fee products that promise protection. They chase strategies that claim to anticipate political risk. They pay for complexity when simplicity would have served them better. The irony is painful. The very moment that demands calm is the moment when fear drives complexity. There is a deeper psychological force at work here. Human beings evolved to respond quickly to threats. In physical danger, hesitation can be fatal. That instinct has not disappeared simply because our threats are now financial rather than physical. When we see red numbers on a screen, our brain interprets them as loss, and loss triggers alarm. Acting feels like regaining control. But investing rewards a different skill than survival in the wilderness. It rewards patience. It rewards the ability to sit still while others react. It rewards the humility to admit that you cannot predict the full consequences of global events. This is the central tension in times like these. You want certainty. Markets offer probability. You want control. Markets offer participation. You want safety. Markets offer resilience through diversification. When Bogle spoke about staying the course, he was not offering a slogan. He was offering a psychological framework. Staying the course does not mean ignoring reality. It means understanding that reality is always uncertain and building a strategy that does not depend on short-term forecasts. Ask yourself a simple question. Did you build your investment plan around the assumption that the world would remain stable and predictable? Or did you build it around the understanding that uncertainty is permanent? If your strategy only works when headlines are calm, it was fragile from the beginning. If it assumes volatility will appear regularly, then volatility is not a surprise. It is simply part of the design. The death of a leader is tragic. The market reaction is dramatic, but neither changes the fundamental mathematics of long-term compounding. Over decades, broad market returns have reflected the growth of corporate earnings, innovation, and productivity. Those forces operate on a time scale far longer than any single news cycle. The question is not whether markets will feel unstable this week. The question is whether you will allow that instability to disrupt a strategy built for decades. Because history has already shown what happens next. History has already shown what happens next, and it has shown it more than once. Markets fall sharply. Fear intensifies. Predictions multiply. And then, often slowly and quietly, recovery begins long before the headlines turn optimistic. Consider the global financial crisis of 2008. Financial institutions failed. Housing prices collapsed. Unemployment surged. The fear at that time was not abstract. It was visceral. Retirement accounts were cut nearly in half in many diversified portfolios. People who had invested diligently for decades opened their statements and saw losses that felt catastrophic. There were serious voices arguing that the financial system itself might not survive intact. If you had sold at the depths of that crisis, your decision would have felt rational. The evidence on the screen would have supported your fear. Yet what followed in the subsequent years was a powerful recovery. Broad market indices not only regained their losses, but eventually moved far beyond their previous highs. Investors who stayed invested participated in that rebound. Investors who moved to cash locked in their losses and then faced the impossible decision of when to re-enter. That pattern is not unique to 2008. After the attacks in 2001, markets dropped sharply amid uncertainty and grief. During periods of geopolitical conflict throughout modern history, markets have experienced sudden declines. Each time, the prevailing belief was that the world had fundamentally changed. In a sense, it had. But the capacity of businesses to adapt, innovate, and generate earnings did not disappear. This is the quiet power of broad ownership. When you own the entire market through a low-cost index fund, you are not betting on a single company's survival. You are participating in the collective resilience of thousands of enterprises. Some will fail, others will thrive. The index evolves. It removes weaker firms over time and incorporates stronger ones. Without you lifting a finger, the composition adjusts. Now imagine two investors during a crisis. Both are intelligent. Both understand the principles of diversification. Both have read about long-term returns. Yet when markets drop sharply, one sells out of fear while the other remains invested. The one who sells feels immediate relief. The bleeding stops. The account balance stabilizes in cash. There is a sense of safety. But markets rarely send engraved invitations announcing when it is safe to return. Prices begin to recover while uncertainty still dominates the news. The investor who sold waits for clarity. Clarity arrives only after much of the recovery has already occurred. The investor who stayed invested experiences discomfort. There are sleepless nights, there is doubt. But there is also participation. When prices rebound, the recovery compounds on the full invested amount. Here is where mathematics becomes merciless. Suppose an investor has $100,000 invested broadly in the market before a crisis. The market falls by 30%. The account drops to $70,000. If that investor sells at that point, the $30,000 decline becomes permanent. To recover back to $100,000 in cash, there must be a deliberate decision to reinvest, and that reinvestment must capture the subsequent gains. If instead the investor remains invested and the market later rises by 43% from the bottom, the account not only recovers, but moves slightly beyond the original $100,000. That rebound is not unusual in historical recoveries. The key difference is participation. Selling interrupts compounding. Staying invested preserves it. This is where psychology quietly sabotages intelligence. Even well-educated investors suffer from recency bias. We overweight what just happened and assume it will continue. If markets have fallen sharply for several weeks, it feels as though falling is the new normal. We also suffer from loss aversion. The pain of losing $30,000 feels far more intense than the pleasure of gaining $30,000. That imbalance pushes us toward action that relieves short-term pain, even if it creates long-term cost. There is also the illusion of control. During chaotic periods, doing something feels better than doing nothing. Selling provides the sensation of taking charge. Yet in broad market investing, the control that matters most was exercised at the beginning, when you chose a diversified, low-cost strategy aligned with your time horizon. The discipline is in refusing to override that decision under emotional pressure. A world leader's death is a reminder of uncertainty. It highlights how little control any of us have over global events. The markets have always operated under uncertainty. The long-term upward trajectory of diversified equity markets has occurred not in the absence of crisis, but alongside it. This is the idea many investors understand intellectually, but fail to internalize emotionally. They can recite that markets recover. They can quote average annual returns over long periods. Yet when volatility strikes their own account, knowledge gives way to instinct. There is a phrase often attributed to Bogle that captures this tension. Time is your friend, impulse is your enemy. Time allows earnings to grow, dividends to be reinvested, and costs to remain minimal. Impulse interrupts that process. It replaces a decades-long horizon with a days-long reaction. When markets shake after dramatic news, you are not being tested on your intelligence. You are being tested on your temperament. And temperament, unlike intelligence, is rarely discussed in financial media. It does not generate exciting headlines. It does not produce dramatic predictions, but it determines outcomes. The investor who quietly continues automatic contributions during a downturn is doing something profoundly powerful. They are buying shares at lower prices. They are allowing volatility to work in their favor over time. They are turning fear into future ownership. The investor who withdraws contributions or liquidates positions is stepping away from that opportunity. Here is the deeper insight that many have never heard explained clearly. Market declines do not reduce the long-term expected return of diversified equities. In many cases, they increase it. Lower prices imply higher future returns if earnings recover and grow. The discomfort of a downturn is often the entry point to stronger long-term compounding. But to benefit from that reality, you must remain present. You cannot harvest the gains of recovery if you have already exited the field. The market does not reward the most informed headline reader. It rewards the most disciplined owner. And that raises an uncomfortable question that must be faced directly. What if this time really is different? It is the most persistent objection in investing. It appears in every generation. It feels reasonable. After all, the world does change. Political systems evolve. Technology transforms industries. Demographics shift. A world leader's sudden death can alter alliances, policies, and economic priorities. To pretend that nothing ever changes would be naive. So let us take the objection seriously. What if this shock leads to prolonged instability? What if markets do not recover quickly? What if the assumptions that held for decades no longer apply? The answer is not to dismiss the fear. The answer is to examine the structure beneath it. The long-term return of diversified equities has historically come from one source, the collective earnings of businesses. Companies generate profits by solving problems, meeting demand, and adapting to changing conditions. When circumstances shift, some firms decline, others rise to meet new realities. The index does not freeze in time, it evolves. It is self-cleansing. Weak businesses shrink or disappear. Stronger ones expand and take their place. If you believe that human beings will continue to innovate, to consume, to build, and to exchange value, then you are implicitly acknowledging the engine that drives long-term market returns. That engine has operated through wars, depressions, political assassinations, pandemics, and leadership transitions. It has never required stability. It has required adaptation. The idea that this time is different usually rests on the assumption that something has broken beyond repair. Yet in most cases, what has changed is sentiment, not structure. Let me tell you a story about two investors who lived through a severe downturn. Both had steady careers. Both invested consistently in low-cost index funds for many years. When the crisis struck, their portfolios declined sharply. The headlines were relentless. Pundits argued that the economic order was being rewritten. The first investor, overwhelmed by fear, liquidated his holdings. He told himself he would return when conditions improved. Months passed. Markets began to rebound, but uncertainty remained. He waited for confirmation that the worst was over. By the time he felt comfortable reinvesting, prices had already recovered substantially. He re-entered at higher levels, but the compounding he missed during the rebound could never be reclaimed. The second investor felt the same fear. She questioned her strategy. She doubted herself, but she reviewed her original plan. It was built on broad diversification, low cost, and a time horizon measured in decades, not months. She continued her automatic contributions. When prices were lower, her contributions purchased more shares. She did not predict a bottom. She simply remained present. 10 years later, the difference between them was not subtle. The second investor's account reflected the full force of recovery and growth. The first investor's account lagged, not because he lacked intelligence, but because he allowed a temporary decline to interrupt a long-term process. The objection that this time is different often masks a deeper fear. It is the fear of looking foolish by staying invested if markets fall further. Selling provides emotional insurance against embarrassment. If things worsen, you can say you acted prudently. Staying invested requires accepting that short-term outcomes are uncertain and that you may endure additional volatility. Yet consider the alternative. If you sell and markets recover, the regret can be corrosive. You may hesitate to re-enter, compounding the mistake. Or you may re-enter hastily at higher prices, driven by the same emotion that prompted you to sell. The truth is that no strategy eliminates discomfort. The choice is between short-term emotional relief and long-term mathematical advantage. There is also the argument that one should move to safety during turbulent times. But what is safety in the context of long-term wealth building? Cash preserves nominal value in the short run, but it does not grow meaningfully over decades. Inflation quietly erodes its purchasing power. Bonds provide stability, but their returns are typically lower than equities over long horizons. A balanced portfolio may include both, aligned with your risk tolerance. But abandoning equities entirely during every crisis undermines the growth component necessary for long-term financial independence. John Bogle never promised smooth returns. He promised market returns, minus minimal cost. He believed that owning the entire market at very low expense, holding it for decades, and ignoring short-term noise was the most reliable path for ordinary investors. He also understood something many overlook. The market is forward-looking. By the time fear is widely discussed, much of it has already been priced into stocks. Prices adjust rapidly to new information. Waiting for reassurance often means buying back after uncertainty has diminished and valuations have risen. The investor who assumes that this time is different carries the burden of proving that the fundamental mechanism of capitalism has permanently failed. That is an extraordinary claim. It requires more than alarming headlines. It requires evidence that businesses as a whole will no longer adapt, innovate, or earn profits over time. If that were truly the case, the performance of your portfolio would be the least of your concerns. The more realistic scenario is that markets will continue to experience shocks, recoveries, expansions, and contractions in an ongoing cycle. Your role is not to predict each turn. Your role is to position yourself so that, over decades, you benefit from the aggregate upward movement that has characterized diversified equity ownership. The emotional core of this decision is quiet but profound. You are choosing whether to trust a disciplined process or to trust your fear in a moment of uncertainty, and that choice echoes far beyond a single headline. It shapes the daily habits that quietly determine whether wealth accumulates or stalls. The philosophy of broad, low-cost index investing is not dramatic. It does not promise brilliance. It does not require constant vigilance. Its power lies in repetition and restraint. When you commit to owning the entire market through a simple index fund, you are making a statement about your future. You are acknowledging that you do not know which company will outperform next year. You are admitting that you cannot consistently predict political consequences or economic inflection points. Instead of fighting that uncertainty, you embrace it by spreading your ownership across thousands of businesses. The practical expression of that philosophy is almost boring. You invest regularly. You keep costs minimal. You rebalance occasionally to maintain your intended allocation between stocks and bonds. You ignore the temptation to chase performance. You resist the urge to flee during downturns. And yet, within that simplicity lies extraordinary force. Imagine two long-term savers who each invest $500 per month into a broad market index fund for 30 years. Assume the market provides an average annual return of 7% over that period, after accounting for modest fluctuations along the way. The investor who remains disciplined accumulates a portfolio approaching $600,000 by the end of those 30 years. That outcome is not the result of brilliance. It is the result of consistency, compounding, and patience. Now imagine that during several severe downturns, that same investor panics and moves to cash for a total of just 3 years scattered across the 3 decades. During those 3 years, the market happens to experience strong rebounds. Missing those rebounds reduces the long-term average return significantly. Instead of 7% annually, the investor effectively earns closer to 5%. The ending portfolio is not $600,000. It is closer to $400,000. A difference of 2 percentage points per year may sound minor. Over a single year, it is barely noticeable. Over 30 years, it represents hundreds of thousands of dollars. That is the quiet brutality of compounding. Small deviations in behavior create large divergences in outcome. Here is the reframe that surprises many people. Market volatility is not the opposite of compounding. It is the mechanism through which compounding opportunities appear. Lower prices during downturns allow new contributions to purchase more shares. Those additional shares participate in future recoveries. The very events that feel threatening in the moment often enhance long-term returns for disciplined investors. The challenge is emotional, not mathematical. You must decide in advance how you will behave when markets shake. You must pre-commit to a strategy that does not require daily reinterpretation. Automatic investing helps because it removes the need for repeated decisions. A predetermined asset allocation helps because it defines your exposure before fear arrives. Low cost matters here more than ever. If you are paying high fees for active management, you are compounding a guaranteed drag on returns. Even a 1% annual fee difference can erode a substantial portion of your ending wealth over decades. Bogle emphasized relentlessly that costs are among the few certainties in investing. Reducing them is an act of quiet rebellion against an industry that often thrives on complexity and activity. There is also a subtle dignity in simplicity. When you refuse to react impulsively to dramatic headlines, you are not being passive. You are exercising control at a deeper level. You are controlling your behavior rather than attempting to control the market. At this point, some viewers may realize that this approach feels almost too simple. That is precisely why it is so powerful. Complexity often creates the illusion of sophistication. Simplicity requires confidence. It requires accepting that the average return of the entire market, earned at very low cost, is sufficient for long-term wealth building. You do not need to predict the next political shift. You do not need to forecast interest rate movements. You do not need to identify the single company that will dominate the next decade. You need time, discipline, diversification, and low cost. If you find clarity in that message, if you value evidence over noise and discipline over drama, then you already understand why this philosophy endures. Surrounding yourself with voices that reinforce long-term thinking can make the difference between staying the course and abandoning it at the worst moment. When a world leader dies and markets shake, the temptation is to interpret the event as a signal to act. In reality, it is often a test of whether you will adhere to the plan you built when your mind was calm. The investor who thrives over decades is not the one who avoids volatility. It is the one who anticipates it, accepts it, and structures life around it. Because the market does not demand constant intervention, it demands endurance. And endurance is built not in moments of calm, but in moments of uncertainty. Endurance is built not in moments of calm, but in moments of uncertainty. When the headline first breaks and markets begin to swing, it feels as though the ground itself is shifting. A world leader is gone. Commentators speculate about instability. Prices move sharply in response. For a brief window of time, the emotional temperature rises and investors feel as though action is required, but step back and widen the lens. The market you own through a broad index fund is not a single fragile structure tied to one individual or one political moment. It is an evolving collection of thousands of enterprises spread across industries, regions, and sectors. It reflects the collective output of millions of workers and the daily decisions of billions of consumers. It is messy, adaptive, competitive, and remarkably resilient. The death of a leader can influence policy. It can alter short-term expectations. It can change sentiment, but it does not instantly erase the need for food, housing, transportation, medicine, communication, energy, and innovation. It does not eliminate the human drive to build, to trade, to create value. Over decades, that drive has proven stronger than any single shock. If you look back across modern financial history, you see a pattern that is easy to miss when you are living through it. There are wars, recessions, leadership changes, inflationary periods, technological disruptions, and crises that feel overwhelming in the moment. Each one generates fear. Each one triggers predictions of permanent decline. And yet, over long stretches of time, diversified equity markets have trended upward, reflecting the cumulative growth of earnings and productivity. This does not mean the path is smooth. It is not. There are deep drawdowns. There are years of stagnation. There are stretches where patience feels exhausting, but the long arc has historically rewarded those who remained owners rather than spectators. The opening tension of this conversation was about danger. The most dangerous moment is not the crash itself, but the belief that crashes will not occur. When you expect calm to last forever, you are unprepared for volatility. When volatility arrives, it feels abnormal. It feels like a signal that something is broken. But when you expect volatility as part of the design, its arrival is not shocking. It is inconvenient. It is uncomfortable. Yet it is not disqualifying. That shift in expectation changes everything. If you build your financial life around the assumption that markets will periodically decline by 20% or more, then such declines do not invalidate your strategy. They confirm it. They are the price paid for the higher long-term returns equities have historically provided compared to safer assets. John Bogle often reminded investors that the stock market is a device for transferring money from the impatient to the patient. That transfer does not occur because patient investors are smarter. It occurs because they allow time and compounding to operate without interruption. Think about what compounding really means. Earnings generated this year are reinvested and generate additional earnings next year. Dividends are reinvested and purchase more shares, which themselves produce future dividends. Growth builds on growth. Over 20 or 30 years, the effect becomes exponential. Interrupt that process during moments of fear, and you flatten the curve. Allow it to continue through turbulence, and you preserve its power. There is a quiet confidence that comes from understanding this deeply. It is not the confidence of prediction. It is the confidence of participation. You are not claiming to know what markets will do next week or next month. You are acknowledging that over long periods, diversified ownership of productive businesses has historically been rewarded. When the next shock arrives, as it inevitably will, you will have a choice. You can interpret it as a command to react, or you can see it as another chapter in a long and familiar story. The headlines will always feel urgent. The commentary will always sound persuasive. The emotional pull will always be strong. But beneath the noise, the underlying mechanism continues to function. Businesses seek profit, consumers seek value, innovation seeks opportunity, capital flows toward efficiency. Over time, those forces compound. If you align your behavior with that reality, you place yourself on the side of endurance rather than impulse. And so when a world leader is dead and markets are shaking, the fix is not dramatic. It is not clever. It is not reactive. It is to remember that you are an owner, not a trader. It is to remember that volatility is a feature of long-term growth, not a flaw. It is to remember that time, not timing, is the decisive variable. The market will continue to process events long after today's headlines fade. Your task is not to outguess it. Your task is to stay with it, quietly, patiently, steadily,